Welcome to the Real Estate Investing Club. This is the place everyday real estate investors gather to share their best stories, biggest insights, and favorite tactics to grow a portfolio of cash-flowing properties in today's market. Here's your host, Gabe Peterson.
All right, we're back with another episode of the Real Estate Investing Club. Today we have Jake Clopton with us. Jake is the founder of Clopton Capital. He is on the mortgage side, commercial mortgage side. So I'm super excited to have him because that is something that is all on people's minds today, interest rates and where that's going. So I'm excited to dive into this. Jake, why don't you get us started? How are you doing today?
I'm good. Thanks for having me on. I appreciate having me on. Definitely looking forward to this.
Cool.
So I guess I can go into my background first, right? And actually my background's pretty good for kind of what's going on today. Before I got into real estate, I traded interest rates. Actually, I traded futures for like 3-month LIBOR and Fed funds and treasuries and stuff. So I did that for a long time before kind of like the 2008-9-ish era. And so, right, you know what happened then? Interest rates went to zero. And, when you trade things, you kind of need them to like move around a lot to like, really make money. And that really wasn't happening. But what was happening was it was a financial crisis, right? And so if you look at like the supply demand side of the business of basically lending money, the supply side not completely, but for the most part dried up, right? But the demand side is still there. And what I wanted to move on to was kind of being an intermediary or broker to help people find capital. Commercial mortgages and, business financing, it was really, it kind of fit into what I was doing already because the interest rates that I was trading were hedging products for corporate debt, right? So mortgages, CMBS, stuff like that, right? So I had a good, kind of interesting background in that. But I didn't have, what I didn't have was kind of like an operational side of understanding kind of the whole mortgage business. But kind of what I understood was if I could find people that were lending, maybe some borrowers would come, right? And that's really what it turned into, right? I just started making phone calls and finding capital. And I'm pretty good at cold calling, right? I have no problem doing that, man. And that's really what it takes. And, 14 and a half or whatever, 40 years later, here we are. And so we're really focused on like the small to middle balance space, right? Like $1 million and up, maybe up to like 100 million. So perm, bridge, construction, and then we also do joint venture equity, right? Which, I like to put a huge distinction between joint venture equity and then like whatever looks like a real estate security, because that's a broker dealer thing, which is what we're not. And then like, all asset types. It's been a long time, so I've done a little bit of everything, a little bit everywhere.
Perfect, man. Well, I'm super excited to have you here because this is knowledge that I need to have on my own side. Because most of the deals that I've done, I've gotten seller financing, and I brought in my own capital or capital from, family members, really close family members. I've never had to go out and raise money, and I generally don't use loans. And so this is a learning experience for me. So you said I picked up a few words in that little excursion you had there. You mentioned JV equity, which is something that I am not. Give me just a rundown of the capital stack in your mind and how it all fits together from a real estate perspective.
Right. So joint venture equity kind of comes into play when you're dealing with, a little bit larger properties, right? So let's say, you need a minimum equity check size of like, maybe $3 million, something like that. That's where like the family offices and then like, the private equity groups are going to start looking at stuff. And we're primarily looking for like shorter term structures, right? So value add, construction, stuff like that. Something where you're going to exit around maybe like a 3 to 5 year timeline, right? Like if you were looking at your IRR on a graph, like right where that starts to bend downward, that's kind of where they want to like exit, right? And then recycle capital. So let's say like, a good equity cap structure is like a 90-10, right? So the equity guys come in as limited partners, right, as 90% of the equity, and then the general partners, with potentially you, right, would come in with 10% of the equity check, right? And then, debt, sits below that. They typically don't want to be behind anything else like mezz or pref equity. And, in depending on who the JV partner is, they'll be comfortable with anywhere between like 65 to 75, typically loan to cost on the debt, which is, considering it's normally a value add or a bridge scenario, or value add or construction, it's a bridge loan or a construction loan for the most part.
Gotcha. So let's just kind of hone in on value add deals, because that's my bread and butter. That's what I do. I don't usually look for things that are nice, because you don't get good deals on nice things.
Nope.
So let's talk a little bit about value add deals and getting those financed, because that, for a lot of people, that is one of the hardest things, is just coming up with the money to buy a deal, especially when it comes to deals that, have horrible P&Ls. I bought deals where they didn't even have a P&L. It was just, an old couple that was running their business, and it was just crap. They put everything on their expense sheet. And it was pretty difficult to bring that to a bank and say, here, take a look at this. Will you fund this? So for difficult type of deals, how do you generally suggest people go about funding those, from the lending side?
Right. I mean, value add is kind of a broad term, right? I mean, value add can be anything from, you're buying a distressed asset and it's totally empty and fixing it up, and, or it could be like buying a B class or a C class asset in a B market, right? And just doing some aesthetic work and then popping rents, right? So depending on which side you're on, is going to kind of depend on which type of lenders, are going to be available. But what drives a lot, like when I'm looking at a deal, what drives a lot of it for me, and one of my first questions is, what does the equity stack look like, right? Is it one guy or maybe two or three, and they're all comfortable going on recourse with the deal? Or is it a sponsor that has syndicated out a whole bunch of equity? Maybe they have a joint venture partner, right? And then, if you have a general partner who owns 10% of the equity, getting them to fully guarantee the entire thing, right? Because your investors aren't going to guarantee it for the most part. That your balance sheet, his personal balance sheet is upside down immediately, right? Because his contingent liabilities are the whole loan, but his ownership is that. So that's when we have to start looking towards non-recourse type of avenues. And that's really the first place I start, right? And generally, to me, if somebody's if I'm looking at where to go for a deal and how to put together, if they're good with recourse, and everybody involved is good with recourse, we usually look more towards maybe banks and stuff like that first, because they have a lower cost of capital for the most part, right? And if we can get kind of the terms that we're looking for, kind of bridgey type of terms where, we're getting acquisition dollars plus a CapEx facility, right? A renovation facility, something like that. And then they go on recourse, great. We're getting 4.5% interest rates, maybe, right, from or something like that, lower cost of capital. But the recourse comes with it. If it's got to be non-recourse, you're really into not banks, right? So bridge lenders, or there maybe are a couple bank programs, but not the type of banks that you're thinking of, right? That different types of programs like that. And generally speaking, the cost of capital is a little higher, but the terms that you see from them are much different, right? So you get the non-recourse money, maybe higher LTCs, right? So some of these bridge lenders are going up to 85% of the total cap. And it's just typically a little bit more flexible of a deal than going with a bank. So generally speaking, banks, recourse, maybe lower leverage. Private lenders that are doing non-recourse, easier, more certainty of execution, and higher LTC. There's generally the points that you'll see between the two of them.
And explain to everybody real quick the difference between recourse and non-recourse.
Simply enough is that recourse, you have an unlimited guarantee to pay back the money. Non-recourse, you don't have an economic guarantee to pay back the money, right? So if the property goes down for an economic reason, you're not on the hook for the money. Yep. There are still non-recourse carve-outs, right? So some people, when they hear non-recourse, they think I have no liability whatsoever, right? Not necessarily true, right? You're still on the hook for bad boy carve outs, and depending on the lender, as they might throw some additional carve outs in there too, like environmental stuff, here and there. And also if there's if there's an aspect to this with a high level of execution risk, right? Like let's say you're doing a renovation deal, right? You may have to still sign a completion guarantee to make sure that hey, you're still going to perform the work, right? Okay. But once all that stuff is done, and considering you haven't done anything like bad, right? So the bad boy carve-outs haven't kicked in. I mean, is if the property goes down for some sort of economic reason, like the market
depression in the area,
recession, stuff like that, you're off the hook for that stuff. Exactly.
Interesting. I've never heard of carve-outs. That's the first time for me. So that's good to know. I didn't know they had those with non-recourse loans. Makes sense though. If you're not actually doing what you said you're going to do, then obviously you got to be slapped on the wrist for that.
Right.
Awesome. So that kind of brings me to the next question, which is just where do you see the market going today? Obviously, we're in March, at the end of March in 2020. Man, time flies really quickly. March 25th, 2020. And so, there's a lot of uncertainty in the air. People are talking about interest rates skyrocketing. People are talking about, the market crashing, all the doomsdayer, things that are being spouted out there. So where do you see the market going in the near termish? So 1-2 years.
Right. So, I think what's happening today is not too dissimilar from what happened right after the Great Recession in 2009, right? You had a lot of the same economic stimulus programs that went into effect, and quantitative easing, and then all the other stuff that they lowering interest rates all the way to zero. But I think what's happening today is the same sort of thing, but bigger and faster, right? So what happened in 2009 and after that, we expanded M2 money supply significantly, right? All the way up to, 2015, 16, right? After the COVID recession, and the money supply expanded in the same amount, that it took, I believe, 4 to 5 years for it to expand after the Great Recession. So it happened at just such a astronomically faster pace. And I think that's one of the reasons why today you're seeing, much more volatility and things are just moving faster, right? I mean, the stimulus and the money supply, it happened just a much, much faster clip, and that's kind of filtering through the system at a faster clip. As far as interest rates, man, I mean, if you remember the entire decade after the Great Recession, all people could talk about was, this is the top. This is the top, man. This is it. We're going down, right? I mean, but it was like every single time the stock market would hit a high, they're like, it's too expensive. It's going to crash. Right.
I remember thinking that in 2012, 2013.
Right. But it just
I'm not going to buy it. It's too expensive.
it just kept going. Right. But I mean, that's the thing when you're in expansionary periods and there's lots of money supply out there, right? Is that things always seem to look expensive. Mm-hmm. But then 2 years later, when you look back, it's like, oh shit, man, that was really cheap. I mean, especially today when you have inflation kind of factored in, right? So let's say you get into a deal and you're like, oh man, that's really expensive, and you buy it for $10 million. I mean, next year, if you have 7% inflation, I mean, even if you don't increase the real value of it, right? I mean, the numbers are going to go up. But the other part of that is that if you have 7% inflation, that means, and if you can borrow money, the lender's loan is worth 7% less next year too, mm-hmm. right? And if you're paying, 4% on it, what's your real cost of capital if inflation's negative 3%? So when you start to look, and I don't think a lot of people, I'm 38, and I know a lot of people kind of in my generation, and Gabe, you look about the same age as me. So,
yeah, 36, baby.
Yeah, I mean, I don't think we've actually dealt with inflation before, and a lot of people just don't really understand that. Yeah. And it is somewhat of a different mindset, right? Because we were taught our entire lives, don't take on debt, don't take on debt, don't take on debt. But if you're actually, if you actually look at it and you're actually getting paid to take on debt, I'm not saying go rack up credit card debt. That's different, right? But if you can make a real business decision about how to, thoughtfully and economically take on debt, I mean, I think it actually makes a huge amount of sense right now, right? And if you can save your equity, take on as much debt as possible. And that's why, I think we're seeing a big explosion in private lending too. with lenders that are more comfortable with higher leverage, right, and not kind of hamstrung by the FDIC. And then credit unions have a different FDIC, but the same thing, right? But they pull back way hard on leverage, and they're like, well, how come people are willing to do 7-8% loans with private money? It's like, well, the real cost capital is still 0% with them, right? And you've got all these other strong economic forces. I mean, like real demographic forces, right? I mean, I don't care where interest rates go. There's still a huge housing constraint, and we just don't have enough supply. So I don't, even if interest rates go to 8%, that doesn't mean we're still housing everybody, right? Yep. So there's real tailwinds in the marketplace. I think that once you look at all the numbers, wholly, some of that stuff comes out of hiding. So. Yep.
Yeah. And that's what I've mentioned to a lot of people, especially when they're, so many people up here in the Seattle market, they're saying Seattle is just, it's overpriced. There's no room for it to go up anymore. And I'm just thinking, we just don't have enough houses though. I mean, it makes sense for it to be going up because supply is not exceeding demand. There's too much demand. And so it makes sense that those prices are going up like this. So taking a holistic view on something like that makes sense. Although is it 7%? Is that a real number for inflation right now?
I've heard everything from 6 to 8 to, I'm just throwing out 7 for an average of whatever. It depends on how you look at it too, right? Because, the government likes to throw out food and energy costs and inflation. I don't know. Those are pretty real costs, man,
Food, come on.
But I don't know, man. It's got to be at least 7%. I mean, I'm guessing McDonald's hamburgers have gone up at least 7%. So that's usually a good, barometer. But yeah, as far as Seattle, the West Coast, as interest rates rise, everybody's saying cap rates will rise, right? But if you look at what happened on the West Coast for the past 10 years, interest rates did rise, but cap rates continue to compress. And and that is really a function of how much equity is in the system, how much money, right? Because when I look at financing a deal anywhere on the West Coast, from Seattle, whatever, doesn't matter, all the way down south, and people are like, hey, what loan to value can I get? And that doesn't matter, because I'm going to get constrained by the debt service way before I get to the max loan to value, right? Because the average you end up seeing is 65, 70%, because the cap rates are 3.5%, 4% or something like that.
Yep.
The rest of the country seems to be on the course to get there. For instance, Charlotte, over in South Carolina, totally other in the country, I'm seeing 3% cap rates and some stuff.
It's ridiculous.
You know what I mean? I'm in Chicago.
So low. It's
the Midwest, those are, we still have decent cap rates here comparatively, right? But stuff's starting to come down here too. And you're starting to see cap rate compression in different parts of the industry, right? Because, you've got a hunt for yield. For instance, I've got guys out of New York City that are, looking at, I can't tell you how many times I've gotten calls from some guy in New York City looking at a mobile home park in Alabama. I'm like, what are you doing? Because it's
that's been me. I've looked at mobile home parks in Alabama.
Yeah, that's what I'm talking. Yeah, because the cap rates, right? So you kind of see this search for yield, and there's just so much equity out there that, I think really what's going to happen on a larger scale is not as much cap rate rising with interest rates, but just more equity coming into deals. Yeah, because it's there, right? It's got to go somewhere. And there's a ton of money parked in the sidelines that eventually will need to go somewhere. So.
Yep. Makes sense to me. It is unfortunate because low cap rates are just not fun. I try to get in. Every deal that I've bought has been around a 9, and I think I've just gotten lucky because that's not a thing that does not exist out there in this world.
Right. No. The great thing about real estate is though, and I have people that don't really understand it very well. So well, I don't know. I could buy a corporate bond that's giving me 4%. Why would I buy a multifamily building that's giving me 4%? Well, there's a lot more ways to make money with real estate, right?
You got appreciation, you got depreciation, you got cash flow. There's more than just
exactly. Yeah. So that cap rate, they're just not really a great, barometer of what you can actually earn for the property.
Yep. But it is just a good indicator on how much the cap rates have been going down. I don't know. Is 3% probably, 3, if it's a class A property out here in Seattle, I bet there are some going for 3.5. But
I bet you can find one on LoopNet for lower, man.
Yeah. Don't get me started on LoopNet, man.
Yeah.
Do not like LoopNet.
Everything on LoopNet today is an off-market value add deal at a 4 cap, which is really a 2 cap.
Yep.
I don't know how it's off-market when it's on LoopNet, but I've legitimately seen that. So I was like, okay, sure, if you say so. Yeah.
Getting off of there.
Yeah.
All right. Well, hey, I just took a peek at the clock. We have gone through our time, so I do need to move us into the quick question round. Are you ready?
Let's do it.
All right. It always starts out with books or any form of education, really. If you like podcasts, YouTube, whatever, just give me 2 recommendations, one for general life wisdom and one for real estate specific. Before we continue on with today's guest, I want to tell you guys about a community I'm launching on School to help investors like yourself grow your own portfolio. In this community, you'll get access to all the docs I use, all the systems I've built, everything I've used to grow my own portfolio, as well as instructions and guidance on how to get out there and find great deals, how to finance those deals, and then how to manage them for great returns. Since we're just launching it, the price will be set at a measly $20 per month, and whatever price you join at is the price you'll have for life. We will be increasing the price as the group grows, so if you're at all interested in growing your portfolio along other investors, now is the time to join. I will put the link somewhere in the bio or on our podcast website at therealestateinvestingclub.com, so if you are interested, head on over there. With that said, let's get back to the podcast.
One for general wisdom. I gotta tell you, what I do every day is I have an RSS feed of like 20 different news outlets.
Oh,
and
nice.
I mean, to me, I think, just go, get together some like good news outlets and set up an RSS feed and go through that stuff every day. Even just look at the headlines. Just even looking at the headlines will give you so much information about what's going on. And, I have them primarily set up for real estate, and like general economic stuff. But I mean, again, even just looking at the headlines, man, that's the best source of information that, I can find. And that's very, very helpful to me in making decisions and I'm talking to people. As far as real estate, we have an ebook coming out in about 2 weeks. So I'll send you the link for that when we get it. And I think I'm just going to put it on our website for free too. So it's all about like capital markets and current trends and stuff like that. So
cool. Right on. We'll put that link in the show notes. If y'all want to jump on that, make sure and grab it. And that is a smart idea about RSS feeds. The title is really all you need when you're just talking about like general trends in markets and just the world today. So that's smart. I've never heard of that one. Moving on, this one is for your younger self. So if you could go back to the Jake who had no experience in real estate and was just getting into lending, maybe he was back there trading futures back before 2008. Go back to him, look him in the eye, give him one piece of advice moving forward.
When I first started, we were looking at all different kinds of lending. At first, like I was doing we were just kind of like forming. So I was doing I think I even financed like some semi trucks at some point. Man. So I'd say, give all that up and just focus on the commercial real estate. That would have been the better advice. So.
Perfect. Focus. That is a theme that pops up here more times than not, is just focus in on one thing. And once you get good at it, good things happen.
You don't want to run too many races. Yeah,
exactly. And that moves us on to the next question, which is habits. Habits form the foundation of our life. So if you could point to one thing you do day in and day out that contributes the most to your overall health, well-being, happiness, and success, what would that be?
I'm sure a lot of people agree with me. Sleep. Getting a good, actual sleep, and taking care of your sleep. I mean, that nothing has had more of an impact on your day and how much productivity you're going to have than actually getting 7-8 hours of sleep.
Yep. And I feel like, you're 38, I'm 36. I feel like the older I get, the more impact that sleep has. I used to be able to, back when I was in my early 20s, I could get, 5-6 hours of sleep and be, whatever, today's a good day. But now that happens and I'm shot. Just doesn't work out.
Yeah, not so much anymore. Yeah, right. So I mean, I have 3 kids too. So throw that on top of it, and yeah, you need some shut eye, man.
I like that. All right, moving on. And this one is for the US. There are plenty of opportunities out there, plenty of places to invest, which means there are a lot of choices out there. So which area in the United States besides your backyard are you most excited to put your hard-earned dollars?
Which cities or state or what?
Metro, it's totally up to your interpretation. What area of the US do you feel has great potential?
It's a good question. I mean, a lot of the stuff that we're doing today, we kind of follow like investment capital. Like the places where I see the most money going towards is really, it just follows exactly along with kind of like the demographic shifts, right? Down to like Florida, places like that. Anywhere where I think you can find an area where, the population is growing and the underlying economy is going. If you're able to buy a property in a market like that, you're probably going to do well, yeah. Right? That said, I, as an investor myself, like I own 3 apartment buildings in Chicago. I don't want to own an apartment building in Florida. Like I got to be able to like go knock on the bricks, But I know a lot of people don't understand or want to invest in Chicago, but what I've been able to do is, I have a couple criteria for like type of properties that we'll buy, and I like to buy it, near a school and near a large public transportation hub, because I kind of look at it. It's a business, right? And I've got to I want to even though it's residential, it's still a business. And what I want to do is make sure that there's enough demand generators there to make sure that we're always going to have people. So I own this one property that's on a busy corner right across the street from a school. It's in a rougher neighborhood, but there's certain things that come along with being near schools that you don't get other places. For instance, if you break the law near a school, your sentence is immediately doubled. So there's no crime on our corner whatsoever, right? So stuff like that, and then if you're into like affordable properties, paying attention to like TIF districts, basically where like the local governments are putting money. That's certainly helpful, and you'll know the areas that are getting attention, stuff like that. So for me, it's somewhere in Chicago where I can identify an area where local governments are putting money, and then there's strong demand generators for people to actually want to live there. So.
Cool, I like that. It's near schools. That's a smart one, especially when it comes to residential. It makes a lot of sense.
Right. So you get a lot of families, and then there's somewhere an employment center nearby because you get teachers and stuff there. So yeah.
Yep. My own, I have kind of a similar, standard kind of litmus test for investing. It's just it has to be within 10 to 20 miles of a Walmart, because Walmart has done a ton of research on where they put their stuff. So I'm all about Walmart. And that leads us to the very last question. And this one is for the listeners, because you've given us so much, good advice, things people I'm sure want to reach out and say hi. So what's the best way for them to do that?
2 ways. You can hit me up on LinkedIn. I'm extremely easy to find. Although I cannot accept any more invitation requests because I hit 30,000, I think. Or just contact us through the website, cloptoncapital.com. I'm always around. This is all we do. So yeah, happy to chat.
All right. cloptoncapital.com. I'll put that link in the show notes. So that wraps it up. Jake, thank you very much for hopping on and talking shop.
Absolutely. Thanks so much. Thanks for having me.
All right. And for everybody who's here with us today, thank you guys for showing up. You are the reason we do this. So if you have any questions whatsoever, reach out to me, Gabe at therealestateinvestingclub.com. Other than that, I hope you guys have a great week. Keep rocking real estate, and I look forward to seeing you on the next episode. Thank you for joining us for another episode of the Real Estate Investing Club. I hope you guys enjoyed the episode and were able to pull some actionable advice that you can go home with and apply to your own investing business. Before you go, I have a gift for you. If you're a new investor looking to get started or an established investor looking to take your business to the next level, I've created an ebook just for you available on the website. This ebook will cover how I was able to create both active and passive income in real estate with very little money to start with. In it, I will address the 3 most often cited obstacles new and veteran investors run into by showing you how to find a deal that's actually a deal, how to finance that deal with little to no money down, and how to exit a deal for maximum value.
And if you get the ebook today, I'm going to bury you in bonuses, 7 of them to be exact. The first, you'll get the off-market lead generation blueprint, which will take you through the exact systems and processes we use to generate off-market leads like clockwork, which is the most important skill when it comes to creating real wealth in real estate. Then you'll get the A to Z REI systems and vendors guide, which will allow you to peek under the hood of our business and see the exact tools and systems and even the vendors we use to grow our business. After that, you will get the top 100 best performing keywords pack, which will give you the exact keywords we use to target leads online and generate leads without having to lift a finger. Next, you'll get the contracts bundle for wholesaling and renting real estate, which will give you access to all of the contracts we use in the field to execute all types of transactions. After that, you'll get the Investor's Quick Analysis Calculator and Offer Tool, which will allow you to quickly calculate whether a deal is an actual deal and will allow you to create an offer automagically from those calculations. Next up, we'll give you the Investor's Daily Success Tracker, which is a tracker you can use to ensure you are taking the right actions day in and day out to reach your financial goals in real estate. And finally, you will get the Wholesaler's Template for Quick Assignment Cash, which will give you the templates we use to present our wholesale deals professionally and efficiently to our buyers. I know that is a ton of things to say. I'm glad you were able to stick with it. So you'll get both the ebook and all of those 7 free bonuses when you download the ebook today. All we charge is the admin cost to run the show. So if you are interested in the ebook and the bonus bundle, head on over to the website at therealestateinvestingclub.com. Click on Get the Ebook Bundle at the top of the page and take advantage of that deal. With that housekeeping item covered, I hope you have an absolutely fantastic day and even better week. Keep rocking real estate, and I look forward to seeing you on the next episode.
All right, before I officially sign off, I have a quick announcement to make. If you're interested in becoming a passive investor in one of my deals, my own company, Kaizen Properties, is looking for capital partners for our upcoming projects. We invest in what are known as recession-resistant assets, mainly self-storage facilities, mobile home and RV parks, and industrial properties. If you're interested in investing and would like to learn a little bit more about my company, our investing criteria, and some of the previous projects we've done, go to the Real Estate Investing Club podcast at therealestateinvestingclub.com and scroll all the way down to the bottom of the page. Click on the Invest With Us button. That'll pop up the investor form. Fill that out, and we will reach back out to you as soon as we can. Or if you prefer a little bit more of a personal touch, you can reach out to me at gabe@therealestateinvestingclub.com. So really, that is it. Again, it was a pleasure hanging out with you guys during this episode, and I look forward to seeing you on the next episode.